Have you noticed that your loan amount keeps going up even though you're making your monthly payments? Hi, this is Trevor, and in this video I'm going to show you why your loan amount keeps going up even though you're making your payments every month, and what you can do about it to lower your interest rate, lower your payment, and pay your loan off faster. I'm also going to include a handy spreadsheet so that you can plug in your real numbers and see what sort of payments you need to make to get out of debt faster. The first thing to understand is the concept of capitalized interest. Imagine this is your loan amount. It doesn't matter what the number is, but imagine that's how much you owe on your statement that says what your loan balance is. If you paid just the interest that was due every month, that would be considered interest only, and your loan amount would never change. It would stay the same. If you pay the interest that you owe plus some of the principal, then your loan amount over time would go down. But in a lot of cases, we are given a minimum payment amount that is actually not even enough to cover the interest that's due each month on the loan. In that case, the lender takes whatever interest was not paid and they add it to the loan amount. So each month, if you are not paying the interest portion of your payment, your loan balance will start to go up. Although it seems like the bank might be being nice by giving you an income-driven payment arrangement where you just pay what you can afford, you're just not paying enough to cover your interest every month. The second reason that sometimes your loan amount's going up is because if you have a variable interest rate on your loan, one that changes periodically, as opposed to a fixed rate in which the rate stays the same throughout the life of the loan, sometimes the amount of interest that you owe each month can go up, and if your payment doesn't change to adjust with that increased interest rate, then suddenly you're back into a situation where some of your interest is getting capitalized and put back onto your loan. We see this happen with student loans, credit cards, all kinds of different loans, especially those that have variable interest rates. So now let's talk about what you can do to stop this from happening and to start actually paying your loan down. The first thing you want to do is understand your interest rate. Sometimes it's not easy to even tell what your interest rate is on your loan just by looking at the statement. You might have to dig down, or you may have to contact your lender to find out what your current interest rate is. Once you understand your interest rate, then you can determine how much interest is accruing on your loan each month. And regardless of what the lender says your minimum amount should be, you want to at least be covering the interest that's accruing. So let's look at that again. You want to find your interest rate, multiply that times your loan amount, and that will give you your annual interest that's due. Then divide that by 12 to get your monthly interest. Once you understand what your monthly interest accrual is, then you know what that interest-only payment would be. If you paid just that amount, your loan balance would never change because it doesn't include any principal. So then you determine if you're able to pay any amount above and beyond that monthly interest amount. If you can, you should, and then you'll start paying your loan down. If you're not able to afford even the monthly interest, then you should definitely contact your lender and see what your options are for refinancing. It's entirely possible that the lender will be able to either modify your existing loan and lower your rate, or another lender will refinance your loan, pay off your existing loan, and give you a new loan with better terms. Sometimes it's easier to look at the numbers, so I created a real simple spreadsheet for you. You can find the link down in the description, and it will help you determine what your monthly interest is and how fast you'll pay off your loan using various payment amounts. So let's go take a look at it. This should be pretty easy for just about anybody to use. You can use it in Google Sheets, or there's an Excel version. And here you can put in whatever your current loan balance is or your loan amount. Make sure you get your interest rate, find out what that is, put that in there. Your lender's minimum payment, and also your next payment date. And this will then allow you to see when, if ever, your loan's going to get paid off at whatever payment you're making. So in this column here, this tells you, based on the information that you put in the yellow boxes, what your interest-only payment is. And if you make that payment every month, that means your balance will never change. It'll just stay the same. So that would be the minimum in any point that you want to pay so that your loan amount doesn't go up. Here in this column, I show what your loan balance will do if you're paying whatever the lender says your minimum payment should be. And in this case, as you see, the lender's minimum isn't even enough to cover the interest. So that means that the loan amount over time is going to go up. And it'll just keep going up at a faster and faster rate forever. So you obviously don't want to make that payment. And then I put in all these sections here so you can compare side by side whatever your monthly payment amount that you can afford or what you think you might be able to do. And you can see how long it will take to pay off the loan. In this example, it will take us about 12 years to pay off this loan at $600 a month. Whereas if we could go up to double that, it would only take us about 4 years to pay off the loan. And if we could go even further, we could pay off the loan here in just over 2 years at $2,000 a month. There's a link in the description to this spreadsheet, so feel free to download it. It's yours to use. I hope you find this helpful. If you like this video, I've got a whole library of finance, real estate, and investing lessons. So be sure to hit that subscribe button, and we'll see you next time. This is Trevor. Thanks for watching.